Good morning, traders. Welcome to the Bookmap channel. My name is Charles. I'm from a community called Piratetraders, where we focus on the ES, the NQ, and how the market moves through the two-way auction process. This morning, I'm going to be talking about the ES and the NQ and trying to give you an idea of what might happen today and throughout this week, carrying forward the information from last week. Okay, so last week was a very interesting week as far as I'm concerned. There is one thing on Bookmap that I blame for everything that happened last week, and it is this giant node of liquidity that is sitting down here at 52.50. Now, if you were with us last Monday, I talked about it then. I talked about it just about every single day in the Brigade live streams, and I'll talk about it again today because there is information that can be gleaned from that node of liquidity sitting down there at 52.50. What is it? Why is it there? Well, first off, it is not trying to make the market come back down to 52.50. It does act as a magnet, okay? But not necessarily a magnet for price to come back down to it. Instead, it just kind of makes it harder for price to run away to the upside. For price to have a crazy trend day where it just gets tons of momentum and does a 100-point move to the upside. Okay? Those aren't going to happen with that node of liquidity down there. That is a sign that market makers are controlling the market. Okay? So all last week, essentially what the market did endlessly, day in and day out, was what we call a slow melt to the upside. It had momentum on a daily time frame, right? Literally every single day, it made higher highs and higher lows over and over again. So it had momentum up on a day-to-day time frame, but intraday each day, it had very little momentum, and it mostly just grinded sideways. On Tuesday, we had one little trend that lasted for, a couple of hours, but for the most part, every single one of these days was a very slow, grindy, choppy move to the upside. Okay? That just means all of this has to do with the market makers that's selling options, hedging their positions, doing whatever they do that causes the market to move in sort of artificial ways. Okay? When I zoom out this morning and I see that that is still there, that liquidity is still sitting at 52.50. The overnight range is still continuing the slow melt to the upside. What am I going to assume for today? We're going to get another day of the same stuff we had last week. Okay? Whatever mechanism is in play here, we hoped maybe the options expiring on Friday would bring it to a close. Apparently it did not. So right out the gate with just those two pieces of information, the fact that we had the slow melt up all last week, okay, and that this node of liquidity was here the whole time, and then opening up this morning and seeing that slow melt continued in the overnight, and we still have that node of liquidity, tells me whatever was happening last week, it's still happening this week. So that is the first piece of information that I'm going to carry forward. That is bullish for the market to have another day like it did all last week, where it just goes sideways intraday while slowly taking the market higher from day to day. But I want to add some context to this. This move to the upside has been built on weakness. Okay? What do I mean by built on weakness? Because it has been bots artificially reversing the market, artificially controlling where the market creates highs and lows, we have left behind an absolutely insane number of weak references on the way up. 2 gaps, one that is a very large gap, and like a dozen weak references on the way up. So if the market keeps doing what it's doing, if it continues to slowly grind to the upside, I'm not going to fight against that. Right? I'm not going to say I should buy a put now because the market has to pull back and repair this weakness. If it's going to keep melting higher, I'll just let it keep melting higher. But at some point in time, whatever mechanism is forcing this to move like this will come to an end. When that happens, this market is set up for a liquidation. Okay, it is set up for a massive pullback on an intraday time frame. That pullback will lead to buyers and continuation to the upside. So you would be bearish in the pullback, you'd be bearish in the liquidation, but as soon as it finds a low, you should assume this market is going to turn around and head right back for all-time highs. Okay? When is that liquidation going to happen? My guess is at some point this week. What will give me a clue that it's going to happen? Whenever this node of liquidity at 5250 disappears, that means the market makers have shut off whatever machine is artificially controlling market behavior, and then the market will be free to have bigger moves. It'll be free to liquidate. It'll be free to get short covering rallies. It'll be free to kind of create some momentum. So I'll be keeping a close eye on this node of liquidity this week at 5250. And if ever it disappears, I expect some sparks to fly afterward. Okay? Until I see that, I'm going to assume the slow melt to the upside can continue. Okay, so let's zoom in on the market profile chart a little bit here. We'll look at Friday's range and we'll ask ourselves, if this slow melt to the upside is going to continue, what will that look like, right? How will we be able to read, based on what's happening in the market today, signals that it's going to keep doing this? Well, if you recall on Friday, and I know this is a little bit messy looking, so just try to stick with me here. On Thursday, we left behind multiple weak references inside Thursday's range, okay? Multiple weak references, including these two down here. You see it say 815, weak C period low, weak D period low. Well, the market opened, okay? It cleaned up a few of those weak references. It turned around and started pushing higher in the B period, and it never came back for those last two weak references. If that happens again today, we can assume the market is going to go higher. So if the market opens and it comes down here and it repairs one of these weak references, we've got a weak reference at 55.68, 55.61, and 55.55. Okay? We've got weak references at all those levels that we left behind on Friday. If today the market opens and it comes back and it repairs one of those weak references, and then it reverses and starts heading up without repairing the other two, guess what that means? We're going to make a new high. The market has momentum. Same thing with the second one. If we repair 61 and reverse without repairing 55, same thing. We're going higher. The slow melt continues. Only if we get below 5555, okay, and get new selling down there, would I even start to feel bearish today. My assumption right out the gate is we're going to get another day like last week, a sideways day intraday that takes the market to higher highs on a daily time frame. So until I see new selling below 5555, that is what I will expect. I will expect that it's going to reverse and we're going to go sideways. With new selling down there, I would start to get bearish. With a dip below yesterday's low, so a dip below Friday's low at 55.48, that is where I would truly get bearish. Because on this slow melt to the upside, they have never let the market come back below the previous day's low. Okay? So if they're going to keep this momentum going on the daily time frame, if they're going to go higher today and tomorrow and the next day and so on from day to day to day, they have got to stay above the previous day's low. So any selling below 55.55, I'm starting to get bearish. Any dip below 55.48, and I am bearish. Okay? The market is likely to start to liquidate. It doesn't mean it'll happen instantly, like, the moment we dip below there, we instantly start to sell off. But if the market dips below there and tries to come back up into yesterday's range, they will turn all these buyers into sellers, and the market will likely head much lower. So getting below yesterday's low would mean look for selling, look for resistance. Anything above it is bullish for continuation to the upside. Okay. I've never been able to make it simpler than this. It really is that easy today, folks. Assume it's going to keep doing what it did all week last week. And the thing that will tell you it's not is if we get below Friday's low. Now, what can happen below Friday's low is sort of one of two scenarios. One is a little dip, and then we start going sideways at higher prices. The other is massive liquidation begins, and we start to retrace several days worth of momentum to the upside. I don't know which of these two will happen if we get below yesterday's low, and I don't know if we'll get below yesterday's low, but either is a potential if we do. The only thing that is a potential if we don't is a continuation of what we've got. A new higher high on the daily and a sideways choppy day. Okay? Now you're saying, well, Charles, are you telling me it's impossible for us to have a massive, just 100-point move to the upside kind of day? I do believe that is very, very unlikely. If it were to happen, it would happen with, support above the overnight high. So if the market pushes above 55.95 today and gets new buying, you should be a bull across the board. Whether it's a slow melt to the upside or it is short covering and momentum to the upside, either way, you should be bullish above the overnight high at 55.95. Okay? Honestly, anywhere above Friday's high, anything above 55.87, you should probably be bullish. Because if they get above Friday's high, they will likely turn it into support for continuation. Okay, so then you say, Charles, you're telling me the highest probability is a slow melt to the upside. You're telling me we're probably not going to make a lower low on the daily. Should I just go long right now? Like before the opening bell even rings. Should I just hit the buy button and go long and assume the market is going to continue higher? The answer to that is no. Unfortunately, we have to be patient this morning. I know it seems like this is always the case on Monday mornings when you guys from the Bookmap community are hanging out, but it's going to be a chop zone. We don't have a gap, at least as of now. And the overnight just chopped and chopped and chopped and chopped all weekend long between 55.71 and 55.90. Okay, it just chopped and chopped and chopped and chopped all weekend long, all weekend. So we should assume that's going to continue this morning. The market is likely to go sideways. It might go sideways for hours before it starts to make its move to the upside. So right out the gate this morning, I'm looking for a chop zone. I'm feeling bullish. And if we repair one or two of these weak references and reverse, I will get very bearish, very bullish very quick. If we get below 55, I'll start to get bearish. Okay? So now let's take a look at the NQ. The NQ and the ES have been moving perfectly in sync with one another, which is what they do when the market makers are in charge. So the story is exactly the same with the NQ as the ES. As long as they continue to one time frame higher on the daily, as long as this slow melt to the upside continues, the market will continue to move higher. The one slight difference that I see with the NQ for the ES is the NQ has kind of already made it to where it should flip and reverse. Okay, this area where we are right now, around the 19,500 to 600 area, that is where, bigger picture, if it weren't market makers slowly melting the price higher on purpose, the market would reverse here. It would get a bit of a dip. It would get a pullback and give buyers an opportunity. It would probably fill the gap left behind on Thursday. So this is a great area for the market to reverse. If it doesn't, it could cause some short covering. So while I don't think we can get a massive trend day to the upside on the ES, I could see it on the NQ if they get above that overnight high. So if they get above the overnight high, you might get some short covering that really starts to create momentum up, as opposed to the slow melt that I'm expecting on the ES. I could see a real move on the NQ. Okay? Because a lot of people will have shorted these highs, and every one of them will be staring at that chart this morning asking themselves, is the market going to reverse or not? And if not, they're all going to have to cover. Okay? So the levels of interest to me this morning on the NQ, it's going to be a chop zone between, it's a big one. It's going to be a chop zone between 19,548 and we'll call it 19,680. This area in here where you can see the overnight range was just going sideways all weekend long. That is a chop zone. So I don't really know what the market's going to do as long as it stays inside there. It may go sideways, it may go higher, it may go lower. If it gets above this node right here, you're likely to start seeing some short covering and some momentum to the upside. So if it gets above 19,680, look for some follow through to the upside. If it gets below 19,548 down here, you may actually dip down below yesterday's low. If you get below yesterday's low on the NQ, you will likely get a liquidation lower. Okay? So I'm expecting a choppy sideways day in the NQ, but once it breaks out of its chop zone, it should get some follow through. It should get some momentum one way or another. So sit back, relax, and enjoy the chop. Any questions from the chat? Come on, chat. Hit me with your cues, your questions. Oh, also, I wanted to take the opportunity this morning to mention I got a workshop coming up 1 month from now, September 16th to 27th. If you don't know what the workshop is, basically it is my all-encompassing trading course. I don't want to bore you with the details, but the long and short of it is, when I figured out how to trade profitably, it was after years and years and years of jumping around from one course to another, from one book to another, from one system to another, from one market to another, and just kept driving myself crazy trying to figure out what is the magical system for making money consistently in markets. And once I figured out what that system is, I decided I wanted to make part of my future teaching other people how to do the same. Because I think there are very few resources out there that teach you the process of becoming a consistently successful trader, right? It's easy to find a system that'll work for a few weeks or a few months, but to be able to do it day in and day out, year in and year out is a whole nother monster. And so I want to teach people how to do that. What is that process? And I have been over the years building out these educational platforms, making them better and better. This workshop, the mastery of markets and mind, is everything that you could need as a trader. So whether you're new to trading and you're just trying to figure out how to get started, you will learn everything you need to know in this course. If you're a trader who's been trading for years and maybe your system just isn't working anymore, the market's behaviors have changed, and you're struggling in this modern environment, we've got what you need in this course. It is meant to be all-encompassing. I got an email this weekend from somebody who's probably watching right now, who basically said to me, he was like, hey, here's my question. He's like, I found you on the Bookmap channel. I've been watching lots of Bookmap streams. I found another person that streams on the Bookmap channel, and I signed up for their course. When I took their course, it just went way over my head. It was too complicated. They needed me to learn a lot more stuff than just Bookmap. They had to have Excel spreadsheets, and they had to have their own indicators, and it was all this stuff that you had to learn, and it was too complicated for me. And his question was, will your course be the same? And the answer is yes and no. So I don't just look at Bookmap. Bookmap is one part of my system for understanding the market. I will absolutely in the course teach you how I look at Bookmap, how I read it, what it tells me, so that you can do the same. I also teach the market profile, which is this chart that you see over here on the left side of the screen. And then I also teach the market internals, which are these charts here. because I combined all of that information to understand how the market works. Okay. To be able to guess, is the market going to go up or down today? I combined information from multiple different sources. So I will go through and teach you each one of those sources one by one, how I read it, how I glean the information, and then I will teach you how I chunk all of that together to make predictions about what the market will do. Okay? Then I will teach you how I enter trades. What are the rules that I use to enter trades? What are the setups that I trade? How do I choose to enter trades? And all of that is fantastic. But the most important thing that I teach in this course, that will probably be the most valuable thing for most of you watching, and the thing that most people afterward thank me for or show appreciation for, is I will teach you how to learn to read the market as it changes. There's two elements that affect your ability to be a successful trader. One is your market understanding. The other is your self-understanding. Market understanding is just the ability to read the chart, ability to recognize patterns and recognize opportunities that come from those patterns. That is just one piece of the puzzle. And I'll teach you that. And there's lots of people, there's lots of YouTube gurus that'll teach you that. But the other part is self-understanding. That is learning how to understand your own psychology, both in terms of reading the charts and in terms of trading the charts. Your own psychology affects your ability to read the chart and understand what it's doing. It's not just the information on the screen. It's how you interpret that information. If you are calm and relaxed, you will interpret the information differently than if you're freaking out in that particular moment, if you're stressed out and you're worried. So learning to understand your own psychology, how your psychology affects your ability to read the market, and then even more importantly, how your psychology affects the way you enter trades and exit trades, that is the set of tools that you can use for the next 20, 30, 40 years of your career as a trader. That is the stuff that matters, and there are so few people that are teaching that. So I'm teaching it all in my workshop. Consider checking it out, marketsandmind.com. If you want to check that out, I'll just quickly show you what the website looks like for ish and giggles. Looks like this right here. If you just scroll down and then you click on this, you can sign up for the course. So the course normally costs $400. Right now, it's got the early bird special going for $350. If you use the promo code morning when you sign up, you can get it for $262.50. So for $260, you can learn everything you need to know about trading to carry forward. Okay. This promo code is just for the first 25 people that sign up. I did it on Friday and we've already had 10 people sign up. So there's about 15 spots left. Marketsandmind.com. Okay. Commercial over. Let's get to the questions. Good morning, Bill, Will, Michael, and Demo Trader. Welcome. Demo Trader says, smash the like button. Yes, please push that like. It is a way to tell Bookmap you want them to keep creating content like this. If you're like, thanks, Bookmap, appreciate you, just hit that thumbs up button. Debbie B in the house, good morning to you. Jay is here. DNK says, what about NQ? So yeah, like I said, I think NQ and ES are probably going to continue to move together. A little more potential for short covering or liquidation on the Q than the ES this morning, but both are in a chop zone and they're going to chop it up likely for a little bit here. Ships in the house. He says, I signed up for the course last week. We will see you there, Ships. Can't wait. Sorry, I don't know how to say this. Lacopo says, can you explain the concept of weak, low, and high? Yeah, so essentially, we look at the market through an auction process, right? So I got to go over this quick because the market opens in 3 minutes. But an auction, basically, think about like an art auction, right? How does an art auction work? As long as people are willing to put their hand up in the air, they will continue to lift that bid higher and higher. So if they're auctioning for 500 and 10 hands go up in the air, they'll go 600. I have 600. Do I have 700? 700. Do I have 800? 800. Do I have 900? And they'll keep taking that price higher and higher until there's only one hand in the air, right? There's only one person willing to bid that price, and then that auction is over. Sold to the gentleman for whatever, right? Well, the stock market or the futures or any, financial asset is going through a two-way auction process. So there's an auction up, where as many people as are willing to bid the price up will go long, and then it'll do the same thing to the downside, and it'll go down as long as there are people willing to go short or sell the longs they already have. Okay? So we're always looking at the market as this auction process where it moves up and down. Well, how do we know when that auction is coming to an end, one direction or another? There's two things we look for. One is excess with price. We read that as being at least two letters, two TPOs, above or below a previous reference. So it's got to get two letters above or below a previous reference, and we look for taper in volume. So fewer and fewer contracts trading hands, the further it goes. So if we look at the overnight low and the overnight high, fewer and fewer contracts and more than two letters at the high and the low. So the auction went down as far as it could go down, and it turned around and came back up. It went up as far as it could go up, and it turned around and came back down. Does that make sense? So intraday, one of the ways that we know that the market might need to come back down or come back up is if we get less than two letters. Well, let's expand out yesterday's range, Friday's range. Right here, you can see the D low only one letter away from the B low. And the market is open. We're looking for chop, sideways, and grind. So the D low is one letter below the B low. The E low is one letter below the A low. And the F low is one letter above the C high. So that tells us none of these lows are good lows. We didn't actually run out of participants willing to go short there. There are still people willing to go short there, and they didn't get a chance. And so that leaves a pocket of liquidity, right? There are orders waiting to fill in here. Now, those orders might be new sellers that are waiting for the momentum up to be over so that they can go short. They might be buyers. Where did the people that bought this D low, where did they put their stops? Probably down here. Where did the people that bought this E low put their stops? Probably down here. What about this F low? Where did they put their stops? Probably down here. So whether it's new sellers waiting for the market to roll over so that they can get short, or just stops from the people that are already long waiting to get squeezed, there is liquidity down here. Okay? And here's the thing about the market. I think about the market like it's an animal, like it's a shark. And the shark is just doing one thing all day, every day, looking for food. And what is that food? Liquidity. Orders that are going to fill. The shark doesn't care if they're longs or if they're shorts. The shark doesn't care if they're above price or below price. The shark is just smelling for blood in the water and will go to wherever there is the most blood. Wherever there is the most liquidity waiting, the shark will go there and get it. So as I see the market slowly melting to the upside, leaving behind these little pools of liquidity, you got liquidity in the gap, you got liquidity in the weak references, you got liquidity in the weak references, you got liquidity in the gap, you got liquidity in the weak references, weak references, weak references. As I see more and more blood in the water below price than there is above, I know at some point this shark is going to come down to eat up all this liquidity, right? At some point the market is going to come back for these lows. So the more of them that they stack up, the more likely the market will get a liquidation. But the tricky part about it is the markets are not moving in a natural way right now. The shark is in a tank. There's artificial walls holding it in place. And that are the market making bots that are controlling the market. We can read those market making bots because we have Bookmap. Bookmap shows us not only that giant node of liquidity down at 52.50. Okay. Oh, that's not on this one. Right there, showing us somebody is playing some sort of game, but also intraday each day, all last week, every single day, every high and low was made by Icebergs. Okay, that's this little indicator that you see right here. Over and over and over again, every high and low was Icebergs. That is computers that are artificially reversing the market. They go long, they go short, they go long, they go short to keep the market stuck in ranges. So I know the market is going to keep doing what it's doing because it's giving me signals it's going to keep doing what it's doing. But whenever it's done, I'll be looking for a liquidation. And those weak references will be the target. Okay, so there it is, folks. Right out the gate, the market is pushing up. We are testing what is that chop zone high right now. We'll call it 55.90. If the market reverses here and pulls back down through the opening price, we will assume that that chop is going to continue. If we can turn Friday's high into support, we're looking for momentum to the upside. My guess right now is chop, but let's see. The fact that we made a higher high on the daily increases the odds. This is going to be another slow melt to the upside day, as that is just what the market wants. I would also say, talking about weak references, the current low is weak because it's one letter below the opening price. So what does that mean? There's orders down here waiting to get filled. Everyone who's long right now has their stop. Well, not everyone, but you know what I mean. A majority of the traders, the short-term traders, the day traders, the scalpers of the world that are long right now, they have their stops right below that opening price. So that is a magnet for price to pull back through the opening and squeeze those buyers. So that increases the odds in my mind of chop. I'm talking about a chop zone if they can do it. A chop zone if we get a pullback. For those of you that are just joining, thank you for joining. Please smash that thumbs up button. We sure would appreciate it. Cog is here. He says he took the workshop last December. Life-changing. Appreciate you, brother. Novice Trader says, well worth it, guy. I think he meant guys, plural. Well worth it, guys. Willie T in the house. Arjit is here. Pavel, good morning to you. Trevor is here. Jason says, missed the morning brief. Am I in 2-tick or 4-tick? I am in 2-tick. The market has just been this compressed. It looks like a 4-tick range, but it is 2 ticks. And I'll tell you guys, just to make things a little more confusing for everyone here, on Friday at market close, I wanted to buy puts. I didn't do it, but I wanted to. Because I was thinking this thing, the ranges are getting tighter and tighter, closer and closer together. It's running out of steam. It needs a pullback. But when I opened up my charts this morning and I saw the overnight continued to slow melt to the upside, I went, thank God I didn't buy a put. And then I double checked that node of liquidity. I was like, yep, that node of liquidity 52.50 is still there. The bots are still in control and they can continue to slow melt it until everyone is frustrated to the max. So do I think this market is getting ready for a pullback on a larger time frame? Yes, I do, but not yet. And the big signal that we're going to get that pullback on a larger time frame is as soon as we make a lower low on the daily. Until we see that, no reason to be bearish. Okay, so you just heard that click, 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 click. Did you guys hear that? That's the market pulse. That tells us everyone's getting stopped out. Where are they getting stopped out? Right at that weak low we just marked, because everybody that was long had their stops right below that opening price. So that hungry shark came down and ate those orders up. Chomp, 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 chomp. So now we got a good low. Now, if the market gets back up to where it was, up here at 90, I can feel much more comfortable getting bullish up there to head up and test the overnight high because we made a good low. The chop zone continues. I'm talking about a chop zone, baby, to see it. NQ is set up for a lot of sideways here. Just looking at the way, let me try to get where you can see it. Just looking at the way the market has been chopping. So push, massive move up, gap up, instant gap and go, tons of momentum. Market's going to the moon. Holy freaking moly. And then it just came to a screeching halt, and it has gone sideways ever since then in this range. That tells me the market needs to continue to go sideways in this range for a while. We'll call that between 19,500 and 19,700, that area. It needs to spend some time grinding sideways. The thing about balance, though, because this is balance, is it leads to excess. It leads to momentum. So if they can get above that overnight high, they can get some serious short covering. And if they can get below, sorry, that's the wrong level. If they can get below Friday's low, they can get some serious liquidation. So I think it's going to be a sideways day in the queue. And at some point they will poke up and make a higher high, but sideways for a while till then. It looks choppy. Very choppy. It looks choppy on the NQ. All right, so on the ES, we're still in a chop zone, but we're back at Friday's high, 55.87. So we're going to ask the same question we asked before. Does the market run out of steam and pull back down through the open, or can we turn this into support? If we can turn it into support, we'll look for a move to the overnight high, which is 55.95. If not, a pullback into the overnight range. 55.78. Can they hold it? Jay says the NQ is appearing much weaker. Yeah, again, I don't like the word much because I feel like they're in lockstep with each other. But yes, the Q looks like it wants to go sideways, whereas the ES looks like it might be ready for a little poke up to that overnight high. Mark says, very informative analysis. This is my first time here. What determines when you will enter a trade? Very simply, when I know what the market is doing. So if I see support at yesterday's high, I can enter a trade to test the overnight high, because at that point I will know what the market is doing. But because it's very choppy, I want to wait to be sure. My rules for entering trades are very simply, do I feel confident? Not guessing, not like, well, I'm pretty sure something's going to happen. Am I confident I know what the market's going to do? If I am, let's say I'm confident the market's going to go up, I say to myself, is there a support level where I could buy a dip, where I would get a good entry in terms of the amount that I would risk? So this is not me recommending a trade, but let's say the market pops higher here and it gets to that overnight high. I could say to myself, if we come back down and test the previous day's high again and it holds, we're going to continue much higher today. So I could watch the market poke up above that overnight high. I could watch it pull back in. I see that it's getting support. Boom, I throw in a limit buy order right there with a stop below the opening price. Because if they're going to get that support and turn around and head higher, they should not come back down through the opening, right? But I got to see a bunch of stuff ahead of time to give me the confidence to get into that trade, because right now the market's in a chop zone. And the definition of chop is you have no clue when or where it's going to reverse. It could reverse at any moment. And you have to just be patient and wait for more information. So I'm waiting for the market to tell me what it's going to do. Right now it says it's going sideways. Son of a bitch. Okay, so once again, twice now, early morning participants, those scalpers that feel they have to jump in a trade right away, have tried to long this market, have tried to get this market to continue higher. Both times they got nothing for it. Okay, so they've got one more chance to turn this little node right here at 55.84 into support and try to take a poke to the upside. We can see there's an iceberg waiting there. Okay. If they can hold it, maybe they can get a move up. If they pass back through the opening price again, we're likely to liquidate a little lower. I'd say down towards 78. So these buyers, they've got to hold the open here or they're gonna get squeezed because they're weak hands, y'all. These are weak hand buyers. So you say to me, well, Charles, if these weak hands get squeezed, is the market going to crash and burn to the downside? Nope. Nope. The bots will step in and we'll just keep chopping sideways. Collard says it looks like they are protecting the opening price to me. Let it bounce there one more time. and I'm going in big with a long, ooh, well, I never tell people what to do. So I'm not going to tell you not to do that. If you want a long, a bounce above the opening price, you can absolutely do that. I would just say if you get the bounce and the market starts to move in your favor, and this is just what I would do. I'm not telling you what to do. I would move my stop above my entry because they're going to get one more chance to hold that opening price. And if it breaks, boom, liquidate everyone. Because you're not the only one that'll be longing there. So if it comes down and you get long and they start to make a move, get that stop above that entry, just in case. Because if they come back down through it again, Jason says, Wednesday FOMC notes that may determine a rate change adjustment, may chop until then. You know what's funny? I would almost always agree with you. A couple of days before FOMC, we're probably going to get choppy sideways days. But because we had choppy sideways all last week, the slow melt to the upside in my book is still choppy sideways. I could see us getting a gnarly day either today or tomorrow where we get some serious squeeze one way or another, either short covering or liquidation. But again, that's just guessing. Let's wait for the market generated information to tell us. I think the closest thing we have to a magic signal will be that giant node that I've been talking about. Mark my words, write it down on a piece of paper and feel free to call me out on it if I'm wrong when it happens. At some point, this node at 5250 is going to disappear. Just poof, out of nowhere, it's going to be gone. And as soon as it does, the market makes a 100-point move one way or another. Just wait for it. Whatever mechanism is causing these choppy markets, this is the signal of it right here. The bot is doing this. And so as soon as that disappears, and it was there all last week, all weekend, still there now, may still be there on Wednesday. But whenever that disappears, look for the market to break one way or to other. Real quick, like within a half an hour of that disappearing. So you say to me, well, Charles, when? When? Well, I can't tell you when. But I can tell you what. Timing the market is a real douche. DNK says, did the tick touch the zero? Yes, it did, but didn't get much for it. So I don't think the ticks matter right now. A lot of times during a chop zone, they're not that helpful. You got to wait for the chop to break one way or the other. Right now, I'm fixated on the fact that all the players this morning have been longs. They keep buying and buying and buying, but the market's not going anywhere. So what happens when people keep buying every dip and the market doesn't rip? There are fewer and fewer buyers on the next dip. And the market is getting weaker and weaker because they've built this house on sand. And there's a hurricane coming if market passes through the opening price. Dun dun. Dun dun. Okay, moment of truth. Last chance for those buyers to defend the open. Can they hold it or do they get squeezed? And it's a squeeze. 300 stops right at the opening price. Thank you, sir. May I have another? That's 300 stops on a single account. One guy just got stopped out for 300 contracts. Sucks to be you, bro. Tom Gunn says, shark. Oh, there's blood in that water, my friends. There's blood lurking at the lows. Can you smell it? Can you smell it? Colored says, I'm tapped in on my long, no guts, no glory. Well, I told you what I think you should do. And I don't argue with the concept of no guts, no glory, right? That's what trading is. You have to be willing to take risks. But over a career, over years and years of doing it, I've learned measuring that risk. Managing that risk is what is the most important thing. And step one to doing that is don't take trades that are guesses, right? Don't take trades where maybe it'll work. Take trades where you feel very confident it'll work. Taking fewer trades with a higher win rate is always a better way to go. But you do need guts, that's for sure. To be a trader, you got to step into risk. That's the name of the game. Paul says, how can you tell that it's one guy? This software right here, this is the Stops and Icebergs add-on for Bookmap. It is basically tracking when one individual account is doing something. So when you see an iceberg here, that means one account was buying again and 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 again at an exact level. If there is more than one account, it will show you. It'll put a little number next to it showing you how many accounts. And the next time we get an iceberg, I'll point that out. But with the stops, it's the same thing. So, okay, so you see how right now it says 147, 1. right? That means one account just layered in 147 contracts one at a time. And this is, of course, happening in milliseconds, right? That's the way icebergs work. They just keep adding another order again and again and again and again and again and again in a fraction of a second to stop price from poking through that particular level. So right now, one account is putting that iceberg in there. If suddenly another account and another account were to put icebergs in there, the number inside the little bracket would change and say 2 or 3 or 4 or however many accounts. And it's the same thing with the stops. So when you see that little red circle, so the icebergs are the 2 little triangles, and when you see the circle, that's a stop. And that means one account got stopped out. I say guy, air quotes, because it's probably a computer, right? It's probably an algorithm, but still. Algorithms are people too. Wait. What? Oh. Percy in the house, good morning to you. Welcome. Any news this morning at 10 a.m. chat? Anything we should know about? Doesn't look like it from the liquidity. Rando says, wouldn't that 312 be a buy though? No, because it's red. The red circle means those were stops from a buy. So those were short contracts. And so if it's red, the person was a buyer that got stopped out. If it's green, it means it was a seller that got stopped out. Now, when you really want to get tricky with it, you could say, well, couldn't the stop be a stop order, right? Couldn't it be a stop order where they're entering a new trade with a stop? So maybe that trader said, he was watching the market bounce up here, and he was like, all right, if we pass back through the opening price, I want to be short 300 contracts, so I'm going to put a stop sell there. Yes, that could also be the case. It doesn't necessarily have to be somebody getting out of a long. It could be somebody who put a new order that is a stop sell. But when you start trying to guess that, it just gets way too complicated. Way too complicated. All right, so my friend who got long at the opening price, I told you what I think you should do. I think you should get that stop above that entry, even if it's just one tick above your entry. Because at this point, if they pass through that opening again, all the traders that just got long are going to get squeezed. So anyway, that's just my opinion. That's just like my opinion, man. John says no news. Sheena says, looks like they are trying to protect the opening price. What does that mean? Protect price? Well, price is an advertising mechanism. Boom. Another account stopped out for 45 at the opening price. What does it mean when they're trying to protect a level? So price is an advertising mechanism. Price makes people do things, right? It affects our brain parts when we see a price go a certain place. One of those places is the opening price. Because if you have stock scanners, they start from the opening price. So as the market is above it, the stock scanner is green and you're bullish. And you're like, yay, market is green, market is bullish. But when it crosses back through that opening price, all the screens turn red. All those stock scanners turn red. And now all of a sudden people who were bullish are thinking about getting out of their trades. And new traders that are neutral are thinking about getting short. So if you want to be a buyer and you want the market to keep going up, you don't want it to pass back through that opening price. So what they will do is defend that level. They'll keep putting in orders above it over and over and over again to stop the price from passing through the open, because they don't want people to change their mind. They don't want to turn bulls into bears or turn people that are flat into bears, right? And there's a bunch of these levels. Previous day's high or low is one of those levels. Overnight high or low is one of those levels. The previous day's closing price is one of those levels. The VWAP is one of those levels, right? There's a bunch of those levels where if the market passes through them, it will start to change people's minds, and that can create momentum. So often the market will try to defend those levels. Oh my goodness. It's so choppy. Oh, so choppy. They just made another poor low. Okay. Man. So those of you that were following the brigade streams last week, you know this market loves to make a poor low and then flip in reverse with whatever bot is controlling things. They made a poor low here with a gap, with an unfilled gap, and then they started a trend to the upside. Okay? That was, what, Tuesday? They did it again on Thursday. They made a poor low with a gap. Turned around and sent it higher. We just made another poor low. Now, this one doesn't seem bullish to me, but if we now get above yesterday's high and get new buying, which we have not done yet, right? Look at the taper in volume. Where does it taper off? Right at Friday's high. That's where we run out of steam and reverse back down. So if that happens again, we're coming for the poor low and the chop will continue. But if we can get through that and turn it into support, then I will get bullish. Just because these bots love to make a poor low. It's so choppy, very choppy. They are going to squeeze on both sides. Yeah, and the NQ is just smack dab in the middle of this chop range. So right now, I would say on the NQ, to carry forward, as long as you're inside the A period. So as long as you are above 19,545 and below 19,625, look for it to keep chopping. Whichever side they break, look for a little bit of continuation. So if they break the A period high, look to head up and test 19,665, looking for resistance there. If they break the A period low, look to head down and test 19,500, look for support there. If you can get through the resistance, it's very bullish. If you can get through the support, it's very bearish. Because in between those two, I'm talking about a chop zone on the NQ. Could go sideways all day long. Not a super exciting setup. But yes, you can make money. Yes, you can make money if you know what to do. And for the ES, it's looking a little more bullish than bearish. It's looking like they want to test that overnight high. But I'll need to see some support at yesterday's high to get bullish. Otherwise, I assume we're coming back down for 55.75. No bounce there. 55.68. No reversal there. 55.61. No reversal there. 55.55. And they have got to hold yesterday's low if they want to keep the slow melt to the upside. With that, I will say farewell, goodbye to all the bookmappers. If you are not a member of the brigade, head on over and watch Bruce's stream. He's streaming now. If you are a member of the brigade, we'll come hang out with the cool kids in the brigade. If you are thinking about signing up for the workshop to learn how to read the market as a two-way auction process, how to use market profile software, Bookmap, market internals, to combine it together to give you an edge in understanding what the market is going to do next. Learn how to manage risk. Learn how to build setups. Learn how to adjust with the market as the market changes over time. If you're thinking about learning any of that, you might consider heading over to marketsandmind.com and signing up today, because that 25% off code, that only lasts for the first 25 people that use it. And we already had 10 that used it on Friday. So there's only 15 spots left for the discount. So I'm just throwing it out there. Something to think about. Oh no, pour high, pour low, chop, chop, chop. The market will go. Good luck, everyone. Happy trading, and we will see you here next Monday. Bam, 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 bam.